Hello and welcome. As we head into 2026, the global investment environment is becoming more constructive, but also more selective. Inflation continues to ease across major regions, which gives central banks some room to lower rates. But high debt levels, narrow market leadership in the US, and geopolitical uncertainty mean investors can't rely on broad market momentum alone. Let's begin in the United States, where equity markets finished December with a mixed tone. The Dow Jones gained about 0.7%, S&P 500 was essentially flat, and the Nasdaq slipped roughly 0.5%. These numbers reflect a market still supported by strong earnings from technology and AI-linked companies, but also one where performance is concentrated in a narrow group of mega caps. Valuations remain elevated, so the coming year will require more careful stock selection. In Europe, returns were modest but stable as inflation trends move closer to central bank targets. Major indices such as the CAC 40 and the DAX both delivered small gains into year-end. Sentiment remains cautious, but with European markets trading at a meaningfully discount to the US, they continue to offer more attractive diversification. The UK also delivered positive December performance, although its medium-term growth outlook remains constrained by fiscal tightening and slower economic momentum. Across Asia, results varied. China showed slight improvements in activity data, but structural challenges, especially in the property sector, continue to weigh on investor confidence. Other Asian markets tied to global technology demand experienced mixed performance, while emerging markets benefited from attractive valuations, but remained sensitive to currency volatility and the US rate expectations. Japan continues to be a standout story. Its equity markets have been supported by ongoing corporate reforms, more shareholder-friendly policies, and a gradual shift away from decades of ultra-loose monetary policy. Although the performance has been strong, investors should expect some consolidation as the market digests prior gains. Turning now to South Africa, local equities finished December strongly. The All Share Index gained over 4%, supported by robust moves in financials, which were up more than 7%, and resources, which rose about 5%. Moderating inflation and improving sentiment helped underpin these gains, though domestic cyclical sectors still require selective positioning given structural constraints and the pace of the reform. In global fixed income, policy paths are diverging. The US and UK have begun modest rate cutting cycles, while Europe remains on hold and Japan continues its historic process of normalization. Bond yields moved higher in December across major markets, which kept long-duration bonds volatile. Short-dated bonds offer solid income, while intermediate maturities strike a healthier balance of return and risk. South African bonds also performed well. Yields moved lower, and inflation-linked bonds delivered particularly strong results. The rand strengthened from around 17 to close the year in the mid-16s against the US dollar, easing imported inflation pressures and supporting bond demand. But fiscal stability remains a key focus heading into the 2026 budget. So what does this all mean for investors? The year ahead will reward selectivity. Narrow US leadership means avoiding over-concentration in mega caps. Global diversification is becoming more valuable, particularly in Europe and Japan. In fixed income, combining carry with moderate duration exposure can help manage volatility. And in South Africa, attractive real yields make fixed income compelling, provided fiscal disciplines remain on track. Markets remain supportive but not forgiving. Disciplined allocation, thoughtful diversification, and an emphasis on quality will be essential for navigating 2026 successfully. Until next time, goodbye.